Have you ever thought about small policies for your kids? A lot of people ask about this, whether their kids are minors, maybe they're adult children now, but we get the question, hey, what would a policy look like if I took it out my kid and paid in $1,000 per year or $5,000 per year? Whatever the dollar amount is, what would it look like? Because I like the idea of starting a policy on my kid where perhaps they don't see the value, but boy, I wish I saw the value, or someone started a policy for me when I was my child's age. It's a good question, comes up quite a bit. So in this video, we are going to answer that, and we're going to look at a couple different scenarios. This video is actually based on an email we had recently received from a mother who had recently received an inheritance, and she would like to take a portion of that inheritance to start policies on her 3 children. Now, her 3 children are grown up, they're adults. They're in their late 20s and early 30s. We're going to go through the specific ages, model everything out like we usually do. But she received an inheritance and would like to take some of that money and start smaller policies for her kids. Now, she mentioned a couple things in her email right out of the gates. The first thing, before we had any communication, she sent this. She said, "I'd like to give these policies to the kids with no strings attached," meaning not required to pay anything after I get the desired dollar amount into the policies. Meaning once she moves that portion of money into the policies on her 3 children, she does not want to be required to pay anything, and she does not want her children to be required to pay anything. The next thing she mentioned is, when they receive the policy, I want them to have access to as much cash value as possible. That is a specific goal of hers. So she doesn't want to have to pay in for a long period of time. I want to get the money into the policy and stop, and then I want them to have access to the money. Now, as we progress through this, we are going to show some options to, one, show her exactly what she wants to see, just from a business process or running a business. My firm belief is show the individual what they want to see. If you, as the professional, the agent, feel better options exist, show that in addition to what they want to see. What drives me up the wall is when I ask for a certain product or service and someone shows me something else because they think it's better for me. It's like, no, show me what I ask for. So if you're in the business, make sure you're always showing the person what they want to see first and foremost, and then you can show additional options. Anyway, let me get back on track so I don't ramble here. So what she had specifically requested is she wants to pay in $5,000 each for each of her 3 children. But here's what she mentioned, which immediately told me she was doing some research, which is good. She was interested in a 7-pay policy. So the nice thing about a 7-pay policy is you can fund right up to the MEC limit for 7 years and then shut it down with what is called a reduced paid up option. This eliminates the premium altogether, and really what you'll find in most cases is that it maximizes the internal rate of return, the overall growth rate of the cash value, on a guaranteed and non-guaranteed basis. It can be very attractive. So that's what she's interested in this particular case. So what we're going to look at here is $5,000 per year going into a policy for 7 years. So that's $35,000 total, 5K times 7 years, but over 3 policies. So that's actually just over $100,000 total. You'll see it when we go through the numbers here. But one of the things I mentioned earlier, show the individual what they want to see. However, building additional awareness is always a good thing in my opinion. We don't want to info overload someone, which I've definitely been guilty of many times, but providing that additional awareness, this way I don't get into an option and then find out after the fact, if I could rewind the clock, I would do things a little bit differently than what I did in the past. So a lot of times when people are interested in starting policies for minors or their children who still have a long way to go just with life, funding it for 7 years and stopping is appealing when you look at the internal rate of return. However, we might want to fund it for a longer period of time. So if we can build in the option to pay into the policy for a longer period of time, would that be something that you might be interested in? Maybe, maybe not. If it was me, I would like to see it as an option. So the kids might see the benefit to adding more money to the policy when they receive it. Perhaps they receive it in year 7 or year 8, and they see, wait a minute, this is a great area to position money. The cash value is safe, liquid, tax-free if it doesn't become a modified endowment contract, or I don't trigger a taxable event. I've got all these benefits, and it's growing between that 3 to 5% per year. Like, I'm interested in that. Can I continue to add more money to this product? Can I keep on feeding the beast? If we exercise that reduced paid up option after 7 years and just shut it down, the answer is no. Back to the options. We can actually go with the same policy where I can elect to stop funding altogether after 7 years, or I can keep funding, and I do not need to decide that up front. We can build in a ton of flexibility, so when I hit year 7, I gift it to the kids. They want to keep funding it, they can keep funding it. Completely up to them. Or we can shut it down. So we don't have to decide now, is my point. Information here, specifically what we're going to look at, is as follows. We've got a 32-year-old male, 31-year-old female, and 27-year-old male. I did not write that info. Let me write it right here quick. Male, female, male. Funding, $5K per year for 7 years. And then also $5K per year for 7 years, and then $1,000 per year, years 8 through 30. Now, they can continue to fund a higher dollar amount, but what a lot of people appreciate, this is just from time and experience, is, hey, what's the policy look like if I pay in $5K per year, but if my son or daughter does want to continue to fund it, I don't know that they're going to be comfortable or have the ability to pay in the full $5K per year. Can they pay just the minimum premium? Or in this case, $1,000 per year. The minimum premium in some of these examples is about $500 per year, a little bit less on some of them actually. But just for the sake of round numbers, we wanted to show the $5K per year for 7 years, and then $5K per year for 7 years. So these two are the same policies, but what does it look like if they keep pumping money into the policy? And we're going to look at two different companies here, Mass Mutual and Guardian, two of your 4 major mutual companies. Let's get into it. What we will begin with is the exact option that she wanted to see, which is this guy, the $5K per year for 7 years with nothing thereafter, not required to pay another penny. Let's have some fun. So, what do we see here? 32-year-old son, 31-year-old daughter, and 27-year-old son. These examples are a pure 7-pay, funding right up to the MEC limit for 7 years, and then shutting it down. I'll actually add that we did overinflate that MEC limit a little bit, which really doesn't matter in this case, but I did overinflate it. It's higher than $5,000, and that allows them to continue to pump money into the policy beyond 7 years if they want to. But here's 7 years, not a penny thereafter. Maximum cash value. First year, $5,000 goes in, about $4,200 right off the bat. What's highlighted in yellow represents the break-even point. So as we look at our total payments, just about year 5, you've paid in $25,000. You have $24,917. By year 6, you are positive. After year 7, you see no payments made whatsoever. The premium's not due. We completely killed it with that reduced paid up option, which eliminates the premium. Once we execute that reduced paid up option, even if we want to add money, we cannot. We can borrow and repay all day long, but we cannot continue to make premium or PUA payments if we execute that reduced paid up option. You'll also notice that the death benefit drops initially when we do this. So here, this is what you wanted to see. So we want to start exactly where the client is, or the potential client is, where they want to start. Cash value continues to grow. Let's take a look at it over the long haul. There we go. If we look at age 70 here, what's he got? $167,000 in cash value, $235,000 in death benefit, based on the present dividend interest rate, which will not remain steady for the next 40 years, or in this case, 39 years. It is going to adjust as time passes. Moving on to the next example, 31-year-old daughter. Same $5,000 in, a little bit stronger cash value, not much of a difference, but a little bit more. By year 5, I'm positive, as opposed to the 32-year-old son, you're still just under $25K. Do you know why the difference exists there? Because they're about the same age, they're 1 year apart. Females live longer than males on average, typically by about 7 years. So what that means is that the internal insurance expenses are a bit lower. Now, going back to that 7 years on average and how that factors into life insurance pricing is if we have a 31-year-old female, that would actually be comparable, subtract 7 from that, to a 24-year-old male. If you were to look at illustrations or just price, quote, life insurance policies, you would find that a 24-year-old male and 31-year-old female would be priced very, very similar, which is interesting when you look at how it works. So that's just me being a nerd and going into life insurance policies to say the reason why I see a clean break even of year 5 with a 31-year-old female and not with a 32-year-old male is because the internal expenses are a little bit less. Even though all things are equal, we minimize the base premium, maximize the cash value like we always do. But because she's a female, you've got a couple dollars more in cash value, $200 in this example, which does give you a clean break even of year 5. Then when we look at the 27-year-old son, with him breaking even year 5, a bit younger here. As we look at this at year 10, check this out. They're all within a couple $100 of each other. And this is the 7-pay with no payments thereafter. So this is just a pretty straightforward example of a mass mutual policy maximized for cash value, max funding it for 7 years. Then, to provide a little bit more detail, we did put this together, which if you've watched any of our content where we've got real estate investors or engineers paying in 6 figures per year, what they like to see is this kind of stuff. In my experience, I've learned that not everyone cares about this, but some people do. So what I like to do is provide really both options. Here's a detailed analysis with the annual internal rates of return and average internal rates of return, which are pulled directly from the full illustrations. And then here's what it looks like without. And then we provide the full illustrations as well. A lot of work to put together on the back end, but really what we're aiming for is full transparency and then also making it convenient for the recipient or the consumer in this particular case. But now we've got the internal rates of return, which look fantastic across the board. Let's look at the 31-year-old female in this case. What this sheet represents, we've got the internal rates of return, but I don't really want to focus on those in this example. What I want to focus on is the different funding scenarios. In fact, let's do that. I'm going to clean this up a little bit. So as we look at this, what do you notice? We've got the company name and the description of each scenario, all on a 31-year-old female. We've got a mass mutual policy on the left. If you rewind this video a little bit, you'll notice that this scenario is identical to the scenario we started with. This is that same mass mutual policy, funded for 7 years, nothing thereafter, cash value continues to grow. Compared to another option, in this particular case, Guardian. 2 of the 4 major mutual companies, can't go wrong with any of them. Even though they project different long-term values, what I've noticed is with Mass and Guardian and New York Life and Northwestern Mutual, they all go back and forth with each other. And I've seen almost all of them argue that we're the best, here's proof of it, but when I look at independent studies, I can't say that one company is just the best. If we could, we would, with respect to the internal rate of return is what I mean when I say that. But we see them always go back and forth with each other. And here, frankly, it's very, very close. If we look at the year 10 mark, 42,776 compared to 42,111. Not much of a difference. And you've got different illustrations from different companies in this example. Break-even point, very comparable as well with the products that we selected here. But then, here's a quick sample of the same policy, funded at $5,000 per year for 7 years. But what does it look like if I want to continue to make payments to this policy? Whether it's the minimum premium of just under $500 per year, or if we just round off to $1,000 per year. She'll be 38 at this point in time. She might say, hey, I like the idea, especially when I look at this policy. I had $1,000. I get that $1,000 back, plus about another $1,600 on top of it. And each year, the growth continues to accelerate. Yeah, this is a great area to position money. I've got the guarantees. I've got the dividends that are paid each year. Dividends are not guaranteed, but have been paid for over 160 years, especially with these 2 carriers. So I've got all these benefits here. So I can keep on feeding this policy, keep feeding the beast if I want to, but I'm not required to do so. And we stopped it in 30 years on all of these examples. We can design it to go longer if we wanted to at different amounts and such. But just from a conceptual standpoint, this allows the individual to see what would this policy look like if I start the policies for my kids and I stop altogether, just like I want, with 2 different companies. We go through the flexibility and such of both as well to help her refine her decision-making process. But then, if they decide to continue to pump money into it, what's the impact look like there? Especially if we go down to, let's say, 85, where the death benefit starts to carry some more weight, or importance, I should say, to a lot of people. And these examples now, $466,000 paid out income tax-free versus the 7-pay examples, $352,000, just about $400,000. These death benefits will be drastically different than what's projected here 55 years down the road, just based on dividends and how they fluctuate over time. But my point is, you will see more money if you continue to pump money into the product, which can be viewed as an advantage, especially when passing money when looking at generational wealth. Whether we've got giant policies, small policies, it doesn't matter. It's all relative, and it is paid out income tax-free. So I hope you enjoyed this one. I enjoyed it quite a bit. Thank you for the email, if you're watching this video, with the questions, because this is a question that a lot of people have, and some additional points, some goals that were laid out. These are good goals just to mention because it does get people thinking with respect to what they can do with high cash value life insurance policies. If you enjoyed this, please hit the like button, subscribe for more. I appreciate you watching all the way through the end. And as always, I hope this helps. Have a great day. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.